Less news. Why consuming less financial news can improve investing outcomes. In modern markets, information is constant. News alerts, expert opinions, social media commentary, and breaking headlines create the impression that staying informed requires continuous consumption. However, research suggests that excessive financial news may harm long-term investment performance. 1. Information overload and decision quality. Behavioral research shows that too much information reduces decision quality. When investors consume constant news, they react more frequently. They overweight short-term events. They confuse noise with signal. Psychologist Daniel Kahneman demonstrated that humans are highly sensitive to recent and vivid information. News outlets are designed to emphasize what is urgent and dramatic, not necessarily what is statistically meaningful. More information does not automatically mean better decisions. Often, it increases emotional volatility. 2. Media incentives versus investor goals. Financial media thrives on volatility, conflict, predictions, sensational headlines. But long-term investing depends on patience, stability, compounding, discipline. There is a structural mismatch between what generates clicks and what generates wealth. As economist Robert Shiller explains, market narratives spread like epidemics. Media amplification can inflate optimism during booms and fear during downturns. 3. News increases trading frequency. Studies in behavioral finance show that higher news consumption correlates with increased trading activity, shorter holding periods, lower net returns. This connects with findings from researchers such as Brad Barber and Terence O'Dean, who documented that frequent trading typically reduces investor performance. News creates urgency. Urgency creates action. Action creates friction. 4. Short-term noise versus long-term fundamentals. Most daily financial news focuses on quarterly earnings surprises, macroeconomic data releases, political developments, market volatility. However, long-term returns are driven more by business fundamentals, competitive advantages, earnings growth over years, valuation discipline. Daily headlines rarely change the intrinsic value of high-quality companies. 5. Emotional contagion. Constant exposure to headlines amplifies fear during downturns, greed during rallies, herd behavior. News cycles intensify collective emotion, increasing the likelihood of buying high and selling low. Reducing news consumption often leads to fewer impulsive decisions, lower stress, greater strategic consistency. 6. Selective information consumption. The solution is not ignorance, it is selectivity. Effective investors often focus on primary sources, earnings reports, annual filings. Review portfolios periodically, not daily. Filter out opinion-driven commentary. Avoid minute-by-minute monitoring. Less frequent, higher-quality information improves clarity. Conclusion. Consuming less financial news is not about being uninformed. It is about protecting decision quality. Less noise. Less emotional reaction. Less unnecessary trading. In investing, clarity often improves when the volume of information decreases. Sometimes, the best advantage is not faster information, but better filtration.